The put will always, 100% of the time, no exceptions to this rule, will go to 100 if it's in the money at expiration. So that's why when you buy that put with the collar, you stop losing at that put strike. It's no more losses.
Brian, is that like putting a stop loss in a sense?
Absolutely. But it's a
Okay.
stop loss that stays there as long as you want it to be. And it's not a stop loss that you get stopped out and then next you know it goes back in the other direction. You're like, I'm stopped out. It's not that
Okay.
type of stop loss, right? You're going to always still benefit if it comes back. Traditional stop losses, you do not because you're out, you're gone, your position is taken away.
Got
So I'm going to go over to this UPro and I'm going to use the UPro to be able to demonstrate why the collar works significantly when things are dropping. Even though the collar strategy is a bullish strategy, but it limits your downside. You do not have risk all the way to zero. If you buy shares in a company by itself, you have risk all the way to zero. If you do a cash secured put, you have risk all the way to zero. If you do a covered call, you still have risk all the way to zero. All of those strategies I just mentioned are bullish strategies. But unlike the others, the collar does not have risk all the way to zero. You can determine where your risks stop. It can stop 1% down. It can stop 5%, 10%, 15, 20%. You determine what risk level you want to take. And once it hits that put, the losing stops. Not immediately, but technically that is the case. But if you understand options, you know that it's delta that's associated with it. And that means the option is moving based on that delta based on a 1 point move. So, what I mean by that, what I want you to know, if you have 100 shares, each share that you own equals one delta. If you buy shares, which most of us do when we first get into these markets, we are buyers of shares. We don't know about options, most of us. We buy in shares. We go into a company like Coca-Cola and we buy in their shares. Every share you own equals one delta. So if you had 1 million shares of Coca-Cola, you would have 1 million deltas. So delta measures is two things, but as for risk, delta measures how much you will make or lose based on a 1 point move, a whole dollar move. So if you had 100 shares, you have 100 deltas, positive deltas, and if it went up $1, you would make $100. If it went down $1, you would lose $100. Okay. Now, delta, when it comes to shares, is static. What static means in this case, it is always the same. It does not change. If you have 100 shares, you're going to always have 100 deltas. No exceptions to this. Now, when it comes to options, though, option delta is dynamic, meaning it changes. So if I bought or sold a option with a 30 delta, it means it's going to move 30 cents for every $1 move. Initially, I said it's dynamic. So that delta can increase all the way to 1 or 100, or that delta can go all the way to 0. It's dynamic. Option delta is dynamic. So I'm pointing this out because once you get this, you can understand a little better how the collar works. Once again, I'm going to repeat this so we can understand. Shares delta is static. It stays the same. Every share you have equals how many deltas you have. Option delta is dynamic. It changes. So if we're doing a collar, we have 100 shares. We have a call that we're selling and we have a put that we're buying. So this shares equal 100 deltas. Positive. I'm going to put a plus. When you're dealing with options, it all depends if you're going to have positive or negative delta. It all depends on what you're doing, kind of going back to the base of options. If you're selling a call, which you are doing when you're doing a collar, then that's bearish because if you sell a call or a call spread, any type of call spread, it's bearish. So in this example, if we sold a call at a 30 delta, we would have 30 bearish deltas. Now back to the basics. If we buy a put, that is also bearish. Buying of a put gives you the right to sell at the strike price, gives you the right to sell the shares at the strike price. So if we buy a put at a 30 delta, we also have negative 30 deltas. So this makes up the collar. You have the 100 shares, you have the call that you sold, you have the put that you bought. And so those are two bearish positions, the call and the put. So that's subtracting from your bullish position of the 100 shares. So when you add it all up, you have 40 positive deltas left. You're still positive. So a collar strategy is bullish. You want it to go up. But because that put option is dynamic, if it starts to drop and it continues to drop, that put delta will increase. It would go from 30 to 50, for example, from 50 to 100. And if it's at 100, that means it's 1 for the shares. So you're losing $1 on your shares and making $1 on your put. The put will always, 100% of the time, no exceptions to this rule, will go to 100 if it's in the money at expiration. So that's why when you buy that put with the collar, you stop losing at that put strike. It's no more losses, but it's not instantaneous no more losses, but technically it is, because if it stays in the money by expiration, you will not lose any more money after that put strike. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video.
Hey, O'Brien, could you actually, based on your explanation here, could you actually make a decision on whether to close the whole thing out, shares and options, as opposed to, and before expiration, as opposed to let everything expire? Let's say the call is in the money. Okay. Can you do it on the basis of adding up the deltas and choose the total delta that's higher?
So on the call side, yes, right? If the call side is in the money, because that means you've made money because the trade is bullish. Going up means you made money. I wouldn't do that on the downside, because then you're realizing a loss, unless you're going to continue the trade. But if you're not going to continue the trade, you've lost it and you've realized it and you've moved on and you're okay with that loss. I'm not okay with that loss, so I'm going to keep the process moving because I know my put is going to protect me from losing any more to the downside. But yes, that's what I've been saying a little bit in the past to everyone, is that if the call goes into the money and it's a 50, 60 delta, doesn't mean you've made all you can make yet, because that call is not 100 yet. It will be 100 at expiration, but it's not 100 yet because it's still time to go. Things can change. A number of you saw my position yesterday in the MES. It was at an 89, 90 delta in the money. Today, it was completely out of the money and never seen in the money again. What I want to say about this, you guys, is that you have to understand what's happening with the movement of your collar position, your collar trade. Understand that once it hits that put, you're technically done losing if that put stays in the money. If it goes back up and that put comes out of the money, you're still better off because the trade is bullish. The put is there for protection. It's not there to make money. It's there to protect from losing too much money.
Brian, is that like putting a stop loss in a sense?
Absolutely. But it's
Okay.
a stop loss that stays there as long as you want it to be. And it's not a stop loss that you get stopped out and then next you know it goes back in the other direction. You're like, I'm stopped out. It's not that
Okay.
type of stop loss, right? You're going to always still benefit if it comes back. Traditional stop losses, you do not, because you're out, you're gone, your position is taken away. This is why we preach this collar strategy a lot, and why we threw it into the safeguard strategy and believe the safeguard strategy is a better wheel, is because it protects you to the downside at a certain point. Yeah, depending on how wide your collar is, your P&L is going to look nasty for a second, but that's fine. I'm comfortable with understanding, okay, the loss is done. It's over. It's like knowing that you have a house and the the damage, the water damage being contained to one room, right? You know that it's done. The damage is done. Yeah, you have some cleanup to do, but it's manageable. The S&P 500 comes back 100% of the time. It's not 99.9%. It's 100% of the time. So if you're doing this on the S&P 500, you just wait it out. The safeguard strategy is like buy and hold on steroids, buy and hold with gasoline to it. You're not just waiting it out, you're still selling things against it. And so if your put is deep in the money, you're going to be able to move that put for a credit each time you adjust it. That's reducing the overall cost basis or reducing your risk every time you adjust that put. And you just wait until it comes back, and it will come back. And if it's anything like recent history, it's coming back fast.